The ECB sounds the alarm. The Eurozone is facing another potential debt crisis. Welcome to Macro Matters, your regular look at what's driving the global economy. I'm Peter Devlin. Fears of another meltdown in the single currency area have resurfaced. The European Central Bank cautioned this week that the Eurozone could be facing another debt crisis, as if the bloc cannot boost growth, lower public debt and fix policy uncertainty. The message was clear from Frankfurt: vigilance is paramount and complacency is not an option. But is Europe heading towards what former ECB chief Mario Draghi described as a slow but painful decline? Well, to help answer that and more, I'm joined by George Buckley, Chief European Economist at Nomura. Welcome, George. Thank you very much for joining us. So let's start with today's PMIs. The Eurozone's manufacturing sector is sinking deeper into recession, and now the services sector is starting to struggle after 2 months of marginal rises. So are hopes of a growth recovery now delayed?
Yeah, these numbers aren't good. It's not just one country either. We've got French numbers weaker, we've got German numbers weaker, the entirety of the euro area, the UK, they're all pretty poor, these numbers. They are suggestive of very weak, possibly even falling economic output. So that's a risk. It may be that there's been a Trump effect here, and certainly that was mentioned in the case of Germany, that that could have seen some uncertainty and concern about what Trump might mean for tariffs and trade going forward, filtering into these figures. And when you look at some of the forward-looking indicators in these surveys, they are even weaker than the headlines. So I think that could be part of it. There is a reasonably good relationship between particularly between the euro area PMI and GDP growth. So worth watching these figures very closely. It's something that the ECB is watching a lot more closely now in terms of the economic output news as opposed to inflation. Now they've they've obviously got a handle on the inflation numbers. It's the growth numbers that are now of concern. So I think these are really important and very weak numbers.
So further warnings from the ECB as well. They did point to poor historical compliance with EU fiscal rules. France has a yawning budget deficit, more than twice the level permitted. So as the budget battle rages on in Paris and with a sovereign rating review at the end of the month, how worried should investors be?
The deficit is much higher than it should be. It's higher than many other European economies. Debt levels are also much higher than they have been in the past. And that's reflected in markets which are ever since the election back in the middle of the year, have been showing elevated spreads relative to Germany on government bonds. So I think the market is right to be concerned, especially when, obviously governing in France is exceptionally difficult. We can't have another election over the course of the next few months. So it's a very difficult situation where you have high levels of debt, high deficits, and now, as you've seen from this morning's numbers, weaker economic growth.
So another winter of high gas and energy prices await for households for the Eurozone. Do you still expect Eurozone inflation to decline below the ECB's 2% target by spring next year?
Yeah, I think it will continue to fall. Inflation is moving in the right track. I think the ECB is reasonably comfortable with the fact that inflation is down. And this is why the focus now for the ECB is a lot more on the growth outlook. And of course, when we say the growth outlook, the reason why we're interested in growth is because that has an implication for future inflation. So if you get weaker economic growth now relative to trend, it's going to generate a negative output gap and then will push down on inflation further ahead. So weaker growth now will have an implication for the ECB's forecasts for inflation looking further down the line.
So finally, George, let's dive deeper into that Trump effect you mentioned. Senior ECB figures already seem to see a trade war as more worrisome for growth than inflation. So overall, should we expect a faster pace of easing in 2025 for the ECB?
I think that the Trump effect, it's going to weigh on sentiment, as we've seen today. It's going to weigh on exports. It could end up raising inflation if there are tit-for-tat tariff increases. And so there's a lot of negativity about this on the growth outlook, and I think that's really where most are going to be focused. If there is an inflationary impact, I think the ECB will generally see through that, largely because if it's inflationary, it means that we've seen a rise in tariffs on from this side of the Atlantic, and that is not really an underlying inflationary pressure. It's more a one-off price hit, a price level hit, and probably a one-off growth hit as well on the downside. So that will be much more important for the ECB than concerns that it's going to be long-term inflationary.
George Buckley of Nomura, many thanks for your thoughts. And that's Macro Matters. Don't forget, you can watch more videos on Reuters.com.